This is webinar 2 of the 6-part webinar series, and I hope you all have set up your brokerage accounts already and kind of got started with the account admin and everything, or you're currently waiting for your account to be set up. So today's webinar will be on stocks and bonds, the most common investing instrument available that most people will come across. So I just want to go through the basics today, and today will be a very light webinar, very fast, and it'll just cover simply what are stocks and what are bonds. So what we'll cover today is the golden rule and what are stocks and what are bonds. So let's first move on to what exactly is the golden rule. So this is the golden rule that applies to almost all investment products out there. The higher the risk, the higher the return, and vice versa. The lower the risk, lower the return. So anything that doesn't follow this rule, for instance, like an investment that you hear of that gives you amazingly high returns of 50% a year and has zero risk, is probably a scam, and you should run away as quickly as you can, because this doesn't abide by the golden rule. And most legitimate investment products out there abide by this rule. If you do find something that is high risk and high return and low risk, and it is legitimate, please tell me too, because I would like to know of such a good deal. Because usually the case is, if it's too good to be true, it is too good to be true. So bearing this golden rule in mind, let us dive right into stocks and bonds. So what are stocks exactly? So stocks are essentially a share of a company. When you buy a stock or a share, you are essentially becoming a shareholder of that company. So if I buy a share in DBS, I'm now a DBS shareholder. If I buy a share in Apple, I'm now an Apple shareholder. So how do stocks make money for you? Well, they make money for you in two ways. Firstly, when a stock rises in price, known as capital gain, and number two, when the stock pays you dividends, which is known as dividend gain. So let's use a simple math illustration to show you what I mean by how stocks gain money for you. So for example, let's say I have $100 with me, and one DBS share costs me $10. So I'm able to buy a total of 10 DBS shares at $100. If the price of each share rises to $11 each, I will have made money, and my $100 will have grown to $110, and I will have just made $10. So that is capital gain. That is earning $10 through capital gain. The second way you can make money through stocks is when DBS decides to pay dividends to its shareholders, which is essentially excess profits the company wants to give back to its investors. Now, dividends is unlike capital gain because it is not guaranteed. Sometimes the company might declare dividends, sometimes it might not. And dividends is usually given out by more established, more mature, larger companies such as DBS or Singtel. In contrast, for growing technological companies, for example, like Amazon, Alibaba, they hardly pay out any dividends at all. So it depends on the company. And if DBS say pays $10 dividends, I make $10. So I will have made a total of $10 from capital gains or price increase and $10 from dividends issued out by DBS, and I will have made $20 on the $100 that I initially invested. So that's how stocks make money for you in these two ways. So stocks typically, on average, give 6 to 8% return a year. But of course, this number varies based on the year at question. So for instance, in the 2008 financial crisis, the stocks were negative. They gave a negative return to investors. But 6 to 8% return a year is the annualized averaged out return of stocks in over good and bad years in the long term. So they are considered high risk but high reward. So why are they high risk? Because there's a lot of volatility involved. The stocks may rise a lot in price when the company is doing well, and when the economy is doing badly, the stocks might drop drastically, and some may never even recover. So it's high risk because the money that you invested, the $100 that I invested, I might not get it back at all if DBS suddenly did badly. But at the same time, if it did do well, and exceptionally well, I would benefit because my $100 would grow exponentially with DBS's gain. So they are high risk but high reward, and this abides by the golden rule. So in contrast, let's now look at bonds. So what exactly are bonds? Well, a very simplistic explanation of it would be, if I buy company ABC bond for $100, I'm essentially lending ABC company $100. And by borrowing $100 from me, they must now pay me interest over the duration that they borrowed the $100. So interest is what you pay someone when you borrow money from them. And bonds can range from government bonds to corporate bonds and even bond funds. Don't worry about these terms. We'll go more in depth into them in the next few webinars. So let's use an illustration. If you buy bonds for $100 and the bonds give you an interest of $1 a year, and the bond matures in 5 years, meaning at the end of 5 years you get back the $100 you lent to the company, you get a total of $5 as $1 times 5 years as interest on the $100 worth of bonds. So you end up with a total of $105. So in contrast to stocks, bonds typically on average give 2 to 4% return a year, and of course the number varies with the financial year at question. They are considered opposite from stocks as they are low risk and low reward. So unlike stocks, excuse me, unlike stocks, their returns are much lower and they are not as volatile as stocks. Therefore, even though you might not make a lot of money from it or exponential growth of your profits from the bonds, you will also at the same time not lose all your money when the economy is performing badly or when bonds are performing badly. So in terms of volatility wise, they are less volatile than stocks. But volatility can work both ways. You can either rise very high or drop very low. And bonds is low risk because it doesn't rise that high, but it doesn't fall that low. So in summary, stocks include companies such as Apple and DBS, and bonds include UOB bonds to the ABF bond fund to the Singapore Savings Bond issued by the government. So stocks are higher risk but high return, and bonds on the other hand are lower risk but lower return. And the composition of stocks and bonds in our portfolio is crucial because it is about asset allocation. So if you are younger and time is on your side and you have a steady income coming in and you are still working, then a higher proportion of your portfolio should be in stocks because you are able to take the risk and you are able to bear the volatilities that stocks have and potentially gain a lot from the rise in stock prices. Bonds, on the other hand, are more meant for people who are increasingly older and they need more security and safety of their wealth. And if they invest in stocks, even though there's a higher return, it might also lead to a greater loss because if stocks do perform badly in that period of time, their retirement nest or savings might be wiped out or might decrease significantly. And therefore, as we get older, the proportion of stocks and bonds must shift. As we are young, stocks reign supreme. So we have 70, 80% of portfolio in stocks perhaps. As we get older, it drops to 60 to 50 to 40 to 30. And don't worry, I'll cover this asset allocation in future webinars. So we need stocks and bonds for diversification. If stocks perform badly, bonds might perform well. And if bonds perform badly, stocks might perform well. And through this diversification, we can protect ourselves from cyclical economy performances. And in the next webinar, I'll be talking about ETFs. So ETF stands for Exchange Traded Funds, and they are a more complex investment product compared to stocks and bonds. But in this webinar, I wanted to share with you the basics of stocks and bonds before we move on to a more complex subject such as exchange traded funds. So thank you so much for listening to this webinar on stocks and bonds. And of course, if you have already set up your brokerage account, or even if you haven't, go set up one right now because it's free and it's really easy to set up. And not to mention, when you do sign up with a brokerage firm, they do have a lot of introductory investment courses for beginners, such as what is stocks, what is bonds, what is investing, what is CFDs, and so on and so forth. And these brokers are trained really well in technical nitty-gritty details of the operation mechanics of stocks and bonds, which they can definitely explain much better than me. I'm just giving you a very simple breakdown of what stocks and bonds are. But if you want to know more, you can ask me, or you can go to your brokers who can probably do a better job in explaining that. I'm not here to teach you stocks and bonds and the fund and the basics. I'm here to give you a real strategy that works. And that'll be over the next few webinars. So don't hesitate to ask me any questions over this week's webinar. And of course, don't hesitate to ask your brokers as well and attend the introductory investment seminars that they have. So thank you so much, and I hope to see you all next this Thursday for the webinar 3 on ETFs.